Hi, the teachers from Cornwall here again. More revision materials, 3.7 cash flow. Major student issue is understanding the difference between profit and cash flow. Think short term, long term. What is cash flow? It's just money flowing in, money flowing out for a particular time period. So it's cash inflow minus cash outflow equals net cash flow. Profit, revenue remaining after all business costs have been taken away. Revenue minus fixed cost and variable cost equals profit. So profit is a source of finance and an indication of success. If profits are going up, stakeholders are more likely to have confidence to invest in the business. That additional source of finance from external stakeholders, coupled with your internal source of finance, retained profit, allows the business to invest and grow. Whereas cash flow is important on the day-to-day basis. Think liquidity. Go back to your financial statements, go back to your ratios. If you don't have cash flowing in, flowing out, cash is the lifeblood of the business. Run out of cash, basically, your business will go bust. Now, fundamental to ensuring your liquidity and your survival of the business for the longer term is maintaining your cash flow cycle and managing it effectively. Now, you will find various diagrams, whichever one you use, entirely up to you, as long as the principles are the same. What I'm using here shows credit stock purchases. You use those credit stock purchases to raw materials in your production process to produce goods or services. Now, that's cash outflow. Why? You're paying workers, you've got other overheads, so cash is flowing out of the business. You've bought your materials on credit, so you have time, normally 30, 60, or 90 days. You have negotiated your payment terms with your supplier. Problem? Normally before, unless you have exceptionally sort of beneficial terms with your suppliers, you will have to pay suppliers for those raw materials. So again, that's additional cash outflow. Those products or services, particularly products, go into your stock. Now, stock holding again, cost. Increase your stock levels. You don't want to hold on to stock, you want to turn it into cash. Now, hopefully that's credit sales. Again, problem, you're faced with cash outflows. You're in a situation now where a vast majority of customers will be expecting credit terms from you. Again, 30, 60, 90 days. Now, eventually they're going to pay. They'll give you cash inflow. But you need to try and balance outflows and inflows and look at your sources of finance, okay, and cash flow forecasts to identify when you have issues in terms of negative cash balances and how you're going to deal with those negative cash balances in the short term to ensure survival. So, key tool for business is cash flow forecast. Goes hand in hand with your profit and loss account, your balance sheet. Cash flow forecast is simply a forecast of your inflows, outflows, opening balances, closing balances over a period of time, normally 6 months. What you expect to happen in the future. You're looking to plan. You're looking to plan and identify months in the year when you think you're going to have issues in terms of your cash flow and continuously plan, have something in place to make sure you have sufficient liquidity to maintain your business. Now, problem, cash flow. Think steeple, volatile nature of the business environment. Look at what's happening out there all the time. Now, this needs to be an ongoing process. Now, this will link into your budgeting, your variance analysis. So each month you should look at your cash flow, look at your forecast. You expected X. What's happened? Is it X minus 10%, plus 10%, or is it actually X? What forced your forecast to be correct, incorrect? What action are you going to take to make sure you stay on target and protect your cash flows? You could be expected to either draw up, finish off, or comment on a cash flow forecast. Now, traps laid by examiners. There are multiple ways of producing a template. Now, points for you guys is not to panic. They all operate on the same basic principle. What do you start with? What's come in? What's gone out? What's left at the end? Now, here I'm using the more complex version of the template. Now, things to look out for. Credit sales. Read the question carefully if you find credit sales or credit purchases. Here, the assumption is credit customers allowed 30 days to pay. So credit sales made in June are actually on the template for July. The fundamental issue with a cash flow forecast is you look at when the cash is received and the cash is actually paid, when it actually comes in, when it goes out. So you do not record credit sales in June for June on a cash flow template. Why? The money is not actually received until July, 30 days later. So add up all of your inflows, then look for your outflows. Now here I'm assuming you've got cash purchases. You have not been able to negotiate payment terms with your suppliers. So look at all of the outflows. What's actually there? Now, other traps in the exam, I always say to students, work horizontally when you're looking at your inflows and outflows. Things they throw into exam questions is in month 3, your wages and salaries, you've given a pay rise, it goes up by 8%. So if you work horizontally, pick out these issues from the questions, highlight, underline them, and go line by line. Look at purchases, are there any changes? Look at wages and salaries, asset purchases, what's actually happened. Take them each item, tick them off one by one, work horizontally, fill the numbers in. Now then you simply just add them up. So you've got your total inflows, A, you've got your total outflows, B. Now net cash flow, as we got here, is A minus B. Now what we're actually showing for the month of June, we've got it in brackets of 1,000. That simply means the fact that £1,000, dollars, euros, more has gone out of the business than has come into the business in the month of June. Now, the net cash flow is again communicating with stakeholders. This is where this statement becomes really useful. You can identify potential cash flow problems. So you're forecasting in June, more cash is going out and coming in. But what did you start with? You started June with 10,000. So 1,000 more has gone out to come in. So at the end of June, what do you have left? 9,000. And the closing balance for June, because it's on the last day of June, becomes the opening balance for July, hence the arrows. Now it's as complicated as that. If you look across in terms of interpretation, the net cash flow shows the fact that it's negative but moves into positive for August. Favourite again exam questions, seasonal businesses. Now if this is a seasonal business, tourism, most of their cash flow should be during the summer, and this is negative, they've got a problem. Or is it a new startup that's only began in June and they're quickly moving into positive cash flows? Now you look at that in terms of sales, profits, etc. Look at the balance sheet, asset strength, liabilities to make a holistic judgment on the business. From 2024 for the first examination's new syllabus, IB has specified a format for a cash flow. Now here it is. It's slightly different from the one you've seen before in this revision video. It's slightly less complicated, but this is the one you should focus in on. Use the previous one you've seen as a learning tool, and then this is the one that should be used in exam questions, and this is the format they will expect you to use when answering exam questions. Syllabus expects you to be able to explain the relationship between investment, profit, and cash flow. Focus on the product life cycle. So if you're introducing a product, there's going to be large cash outflows, minimal cash inflows. You've got to look at the liquidity position of the business. You're spending on the launch of the product. The product has to be established in the marketplace. Once it's growing, the promotional activity can be cut back. So again, lower cash outflows, higher cash inflows, profits start to rise. Maturity, cash inflows, outflows stable. Profits may fall. You may have had to use price reductions. You're looking here, rather than being something that's majorly profitable, is help protect your cash flow. It's guaranteed sales at minimal profit levels compared to what it was 6 months ago, a year ago, etc. Decline. You've got to look at profits and cash flows for sales decline. Decisions required, future the product or service. Why again, lots of products in decline on your life cycle that could have major impacts on your liquidity position. But you may decide to look at extension strategies. Problem: increased investment, cash outflows create new USP. Okay, it could be redesigning the product itself. It could be rebranding the product totally. Again, that costs money. So increased investment, increased cash outflow in the short term. Again, issues for liquidity, depends on your position. Go back to your ratio analysis. Sales would likely increase far quicker than a brand new product being thrown into the marketplace. Why? The name will be out there. I'm thinking about the redesign of the mini car years ago. Quickly they redesigned it in terms of the product and promoted it to a different market segment, and quickly sales took off. You would definitely be expected to come up with solutions to cash flow issues. So reducing cash outflows, increasing cash inflows, looking at sources of finance. Reducing cash outflows, improving cash inflows, relatively straightforward in terms of look at reducing cash outflows. Bullet point number 3, motivate staff to reduce absenteeism. So going back to HR, lots of staff off absenteeism. Is it sick pay? Are you having to hire agency staff? Motivate those staff to actually be in work. Cut your costs. Energy saving opportunities. Look what's happened to energy costs over the last 12 months globally. Now, the additional finance, this is where the short-term, long-term comes in, where you can show your higher value evaluative skills. An overdraft is allegedly a short-term source of finance. It has to be renewed every 12 months. An overdraft can be potentially expensive. So as a business, you look to manage your cash flow facility, where if you're using overdrafts and debt factoring, they are very, very much a short-term solution, because again, they cost money, will have an impact on your profitability. So think cost and time span of their use, and if there's a long-term declining cash flow, you need to look at major surgery for the business. Again, hopefully this has been useful. Keep on watching our YouTube channel. More revision materials coming your way.